Check this out. The price sweeps the low, grabs the stops, and snaps right back up. That's your signal. But how do you know which low is the real target? If you want to learn this secret scalping strategy that not only turns stop hunts into entries, but also shows you exactly which swing points to watch for, stick with me. Today, I'm teaching you a powerful scalping strategy using pure price action on the 1-minute time frame. Forget most indicators, we're focusing on liquidity grabs, the very moves that trick most traders, and the kind brokers might prefer stay hidden. But here's why this is different. You'll learn my specific playbook, which is only looking for 2 distinct V and U swings, to pinpoint the high probability liquidity zones before the hunting happens. You'll also see the surprising math showing why the market might be much easier to push around than you think, especially for these quick 1-minute price moves. But that's not all. I'm also going to reveal one simple candlestick clue that helps you avoid those devastating traps when it's not a stop hunt, but a real liquidity run. And forget exiting too soon. Later in the video, I'll show you how the pros use one simple tool to ride the profit wave longer than most retail traders dare. Make sure you watch this entire video to connect these crucial pieces together. All right. This is how we're scalping the market the right way. But first, what is this liquidity stuff? And what are these stop hunts really? Let's break this down super simple. Let's backtrack to put it very simply. Think about it like this. It is waiting orders. You know, like your stop loss order. It's just sitting there, waiting for the price to hit it. Lots of traders put their stop losses in similar spots, right? Like just below a support level where the price bounced before, or just above a resistance level where price stopped going up. Therefore, you get these big groups of waiting orders all clustered together. Now, some really big players in the market, guys trading huge amounts of money. Sometimes they need to buy or sell a lot, way more than it is just sitting there, waiting normally. So what do? Sometimes they push the price action on purpose right towards those groups of stop losses. You know, that quick, sharp spike you see on the 1-minute time frame that seems to come from nowhere, that's often the stop hunt. So these big players push the price action for stop hunts. You might be thinking, but the market is huge, like trillions of dollars. How can anyone push the price around, especially just for a quick scalping trade on the 1-minute time frame? That's a really good question. You might be thinking this, but I'll address that in a few seconds. You hear the big numbers, right? Maybe from brokers, like 7 trillion traded every day. It sounds so big that nobody could possibly move it. But here's another little secret. That big number is a bit tricky. I'll explain why in just a second. Think of it like this. That big number gets spread out a lot. Let's look closer. First, that 7 trillion is split between lots of currency pairs. Maybe 28 or 30, the main ones that people trade. So divide 7 trillion by, let's say, 30 pairs. And the average amount for just one pair is already much, much smaller. It's like $233 billion per pair, per day, on average. Still a huge number, but much smaller than $7 trillion, right? Okay, and then that $233 billion for one pair happens over 24 hours period a day. So we need to spread that amount over all 24 hours. Divide 233 billion by 24 hours. That gives us around 9.7 billion per pair per hour on average. Getting smaller, right? Now think about the price on our 1-minute chart. Let's say a pair moves about 100 pips up and down in a typical day. That $9.7 billion traded per hour isn't all happening at one price pip. It's spread across those 100 pips. So divide 9.7 billion by 100 pips, and now we are down to roughly 97 million per pip per hour on average. And remember, there are buyers and sellers at each pip. So we kind of split that 97 million in half for the buy side and the sell side of the market. That leaves about 48.5 million waiting on each side at each pip each hour on average. Now, $48.5 million still sounds like a lot, but remember, that's just an average spread out over an hour. When you break it all down like that, at any one moment, especially on a fast chart like the 1-minute time frame when we are scalping, the amount of waiting orders liquidity right here, right now, might be waiting at this specific price can be much less than that. It can be quite thin sometimes, and that is why stop hunts work. It all boils down to one thing. When the market is thin, it doesn't take billions to move the price. A big enough order can push the price action those few extra pips much more easily than you'd think, especially when scalping. The crazy thing about it was how this simple math makes sense. So they push the price just enough to reach those spots where all the stop losses are waiting. Just enough to do that quick stop hunt we talked about. So when your stop loss gets hit, you're forced out. And guess what? It's usually not your broker doing it. People worry about that, but it's more often these bigger traders. They need to get their big orders filled. Now that we know what they are and why they happen, how do we use this information? How do we spot them and use them in our scalping strategy to actually make profit instead of getting caught? That's the secret part. Now onto the fun stuff. Let's look at the setup. Okay, so we know these tricky stop hunts happen, especially on the 1-minute time frame. They target liquidity sitting below support at swing lows or above resistance at swing highs. But how do we know which swing lows and highs are good spots to watch? We don't want to watch every little price move on the chart, right? That's confusing. If you're struggling with identifying key levels, this will help you. For this simple trading strategy, we only focus on 2 main types of swing lows and swing highs, good quality ones. Here are the 2 types. First type is the V-shaped swing. This one is easy to spot. For a swing low the bottom point, first you see the price push down hard and fast. We want to see a strong bearish candlestick or 2-3 candles making a quick movement. Then, right at the very bottom point, price doesn't stay there long. It turns around quickly. Maybe only 1, 2, or maximum 3 candlesticks hang out near that lowest point. And then, the price shoots back up fast, maybe with strong bullish candles. It makes a sharp V-shape. That quick down, quick turnaround, quick up price movement, that's a quality V-shaped key level. Same idea for a swing high, just flipped upside down. Fast up, quick turn, and fast down price movement. The second type is the U-shaped swing. This one is a bit different. Price still pushes down fast, just like the V-shaped swing. But instead of turning around right away at the bottom, it gets stuck moving sideways for a little bit, like in a consolidation or tight range. It might make a little box shape down there with maybe 4 or 5, up to maybe 10 candlesticks bouncing sideways near the low or support level. Then, after that little pause, it makes its move and pushes back up strongly. So it looks more like a U with a flat bottom shelf. Again, same idea for a swing high. First, the price moves fast up, then sideways consolidation near the top resistance level, and finally a strong push down to complete the pattern. So why did we decide to focus specifically on these 2 types of swings? For this 1-minute scalping strategy, we only really pay attention to these clean V-shapes and U-shapes. So forget all the messy, choppy price action in between. The thing is, these good quality swing highs and swing lows are often where the real liquidity sits. Why? Because everyone sees them. I think this is probably the most important thing that you need to be doing if you want reliable setups that you are probably not doing, which is focusing on clarity. So these levels are more likely to be targeted for a liquidity sweep or stop hunt before a potential reversal pattern happens. This will also help you only take A+ trades. So step 1 is finding these V or U shapes on your 1-minute chart. These are the zones where we'll look for the stop hunt to happen. But without this next step, finding the zones is useless. The next crucial step is knowing what to do when price attacks one of these levels. That's the entry model, and I'm going to show you exactly how to get in. Let's look at that. All right, so you found a nice clean V or U shaped swing low, which is our key support level, or swing high, which is our key resistance level on the 1-minute chart. You know that this is a likely spot for liquidity to be sitting just beyond it. The real key to this is identifying the quality level first. Now, we watch and wait for the price action to attack that level. Let's say we're watching a swing low. We wait for the price to push below that low. This move looks like a breakout downwards, right? But we suspect it might be the stop hunt, that liquidity sweep. Here's the most important part of the entry model. This point was super important. We don't jump in just because price broke the level. You're doing trading wrong if you chase breakouts blindly. We need confirmation that the breakout is failing and it really was just a quick liquidity grab. So, after price dips below that swing low, we wait and watch the very next candlesticks on the 1-minute time frame. If that downward breakout was just a liquidity sweep, the price is unlikely to have enough momentum to move significantly beyond that level. Before we enter the market, we wait for the first green candle bullish candlestick to form after that sweep below the low. Look at that. That first green candle is our signal. The way I knew that buyers were back was seeing that immediate rejection. This shows that the buyers are stepping back in immediately, rejecting the lower prices. That's our confirmation. We typically enter the buy trade either as the first green candlestick is forming with strong upward momentum or right after it closes. Same idea if price sweeps above a swing high, our resistance level. We wait for it to fail and look for the first red or bearish candlestick to form after the sweep. That is our signal to enter a sell trade. This is a powerful reversal pattern setup. Now this one thing changed everything for my scalping strategy. Let me show you why. I'll also show you 2 small trading tips that can help us feel even better about entering the trade. But that's not all. The first tip is to look after candlesticks with big wick rejection. Look at that. Do you see that candlestick that did the sweep? The one that broke the level. Did it left behind a long wick sticking out? We want the wick to be much bigger than the wicks on nearby candles. That big wick is like the price saying nope. And it makes a bounce or reversal more likely. That point was super important because it's an extra confirmation. Now, the second tip is to watch out for big displacement candles. What if the candle that breaks the key swing low is a huge, solid bearish candlestick with almost no wick, and it closes far below that level? That's called a displacement candle. But this kind of candle is a big problem for our setup. The thing is, that's not a stop hunt, it's a liquidity run. So the exact opposite signal. I found out that's real momentum, likely a real breakout that signaled the start of a downtrend. In this case, this scalping strategy tells us, do not try to trade against it. We don't want to fight strong momentum. So we skip the trade. So the entry model is simple. First, find a good V or U shaped swing level. Second, wait for the price to go just past the low or high, which is the liquidity sweep. If the breakout fails, get ready for a quick scalp trade. Enter when you see the first candle going in the opposite direction of the liquidity sweep. A candlestick with a big wick is a nice bonus, but don't enter if the breakout candle is big, strong, and closes far past the level. It's a science with a proven formula. Well, almost. Okay, we know where to look, we know how to get in. But without this next step, it's all for nothing. Where do we put our stop loss and take profit? Let's cover risk management. I think this is probably the most important thing, setting your initial stop loss. This is super important for any scalping strategy. So, where does the stop loss go? Right after you enter, place it just beyond the furthest point of that liquidity sweep. If you bought after a sweep below a swing low, put the stop just a little bit below the lowest wick of that sweep. If you sold after a sweep above a swing high, put it just a little bit above the highest wick. Keep it pretty tight. This defines your initial risk. Keep in mind you do not want a wide stop loss for scalping. Now, for taking profit. The good news is that these reversal patterns after a stop hunt can lead to strong, quick price movements. We want to catch a big part of that move. That way, we get a better risk to reward ratio. We don't want to jump out too early either, just because we see a little green candlestick in our favor. You're doing profit taking wrong if you exit too soon. You should be doing it this way. One simple trading strategy I've followed many times is using a trailing stop loss. Instead of picking a fixed profit target right away, we can use a fast moving average line on our 1-minute chart. Something like the 9 EMA, the 9 exponential moving average, works well. Think of it like a safety line that follows the price action. Now, how do we use the moving average? Once you're in the trade and it starts moving in your favor, you stay in as long as the price stays above the 9 EMA line, or below the 9 EMA line if you're short. Your exit signal comes when a candlestick closes on the wrong side of that 9 EMA line. So for a buy trade, if a candle closes below the 9 EMA, that's your signal to get out and take your profit. For a sell trade, if a candle closes above the 9 EMA, you exit. Here's what happened when I started using this trading strategy. My winning trades became much larger. However, sometimes the price might just explode in your direction and keep pushing with no pullbacks. You see a huge candle, maybe two, really accelerating far away from that 9 EMA line. That super fast momentum often can't last. When you see that big impulsive move, that can also be a good signal to just take your profit right there, even before the price crosses the EMA. You capture that strong burst in the price. That's all that matters when scalping. The beauty of this risk management approach is it helps you catch bigger moves when they happen. Aiming for a good risk to reward ratio, maybe 2R, 3R, or even more than your initial small risk. The real key to this is to let the market tell you when to exit, not guessing. Even if you don't catch the very top or bottom, you catch the main, strong part of the move after the liquidity sweep. Doing this helps you build consistent profits over time. You're not guessing profit targets, but you're letting the price action tell you when the momentum might be fading. It also helps stop that FOMO, that fear of missing out. So here's the plan. Start with a tight stop loss, then trail it using a fast-moving average or exit if the price makes a strong push. This is a simple but effective risk management for this insane scalping strategy. Now, if you're really serious about mastering this, if you want to learn why these liquidity sweeps and stop hunts work the way they do, and see the bigger picture of market structure that the big players use, you absolutely need to see how liquidity plays out on a larger scale. The good news is that's exactly what I break down in this video right here. Click it, watch it next. It connects all the dots. If you like this breakdown and the brand new scalping trading strategy insights, hit that like button and subscribe for more. Thanks for watching, and I'll see you in the next video.